So my presentation, my topic is on passive versus active application of industry exchange traded fund investment strategies, an empirical study on the S&P Global 1200 Index. I'll talk you guys through my chapter 2 from start to finish. So my chapter starts on the modern portfolio theory. Now the modern portfolio theory was proposed by Markowitz in 1952. It's a theory that proposes a relationship between risk and return of an asset or a portfolio, and is based on the basic tenets of the expected utility theory, which was proposed by von Neumann and Morgenstern in 1944. Now what the expected utility theory states is that utility increases with an increase in wealth levels. However, this increase occurs at a decreasing rate, and that's what we see in the curve that I've just put up there. The curve has a concave shape, so as income or wealth increases, utility continues to increase, but it starts to flatten out. And this suggests that investors are risk averse and therefore require higher compensation for taking on higher risk. The MPT also brings to light the concept of diversification, whereby investing in two assets that have a low correlation will help reduce risk while maintaining your returns. And this can be achieved by diversifying away firm-specific risk. The concept of diversification also appears in the concave shape of the efficient frontier, which we can look at now. Now the efficient frontier, any investor is exposed to a feasible set of risky assets, and that's what we see with the dots around inside, like on that side of the diagram there. And the efficient frontier provides the portfolios that provide the highest level of return for a given level of risk, or the lowest risk for a given level of return. And that is depicted by the most northwestern portfolios, which is from point MV to point X in the diagram up there. Now, any portfolios that lie below the efficient frontier of risky assets are inefficient. Any portfolios above the efficient frontier of risky assets are unattainable. Now from point MV to Y, the dashed portion of the, you don't even consider it as part of the efficient frontier of risky assets, is known as the inefficient portion. This is because you can achieve a higher return by investing on the corresponding solid segment of the efficient frontier for the same level of risk. Now not all investors want to invest completely in the risky assets. Some are more risk averse than other investors. Therefore, Tobin suggests that you can invest part of your portfolio in the risk-free asset and partly in the risky asset, which gives rise to the capital allocation line. In this case, you can see from the risk-free asset to portfolio A, we've got capital allocation line A. Similarly, you can invest in a higher capital allocation line, such as capital allocation line B, which is between the risk-free asset and portfolio B. Now, any higher capital allocation line is preferred because it provides a higher level of return for a given level of risk. So in this case, we see that capital allocation line B dominates capital allocation line A. In that manner, if we keep moving up or ratcheting up the capital allocation line, we reach the point of tangency between the capital allocation line and the efficient frontier of risky assets, which occurs at point M. This is the highest attainable capital allocation line, or as dubbed now is the capital market line. At this point, we can bring in Tobin's separation theorem. Now, what Tobin tells us is that we can separate our investment process into two distinct steps. The first step is identifying the market portfolio, which occurs at the point of tangency. This market portfolio is characterized by the highest Sharpe ratio or highest reward per unit of risk, or highest excess return per unit of total risk. The second step involves deciding how much to invest in the risk-free asset and how much to invest in the risky market portfolio. Now, a more risk-averse investor will select a point such as point C, as he has part exposure to the market portfolio and partly to the risk-free asset. Whereas a less risk-averse investor will invest in an asset, for instance, will invest at point D, so he'll borrow at the risk-free rate and invest the total amount in the market portfolio. Okay, we've already discussed all that. Now, the modern portfolio theory, like many other financial theories, is underpinned by the concept of market efficiency, which was promulgated by the efficient market hypothesis. Now, the efficient market hypothesis assumes that investors are rational, risk-averse, and mean variance optimizers. One of the theories under the concept of market efficiency is the random walk hypothesis. The random walk hypothesis states that there is no serial correlation between successive price changes. Therefore, price changes are independent, and that results in no trends or cycles within a price series. This is also attributed to the unsystematic entry of information. So information, there's a 50% chance of a price increase or decrease as the information entry is unsystematic. And the main challenge to the random walk hypothesis has been that there has been a presence of serial correlation within past prices and price series datasets. Subsequently, the efficient market hypothesis, promulgated by Farmer 1965, 1970, and 1991, states that prices fully and fairly reflect all available information, and that investors use information sets to drive their decisions, and the EMH suggests three types of information. We've got past price and volume data, fundamental and macroeconomic data, and inside information. Based on these three forms of information, the EMH proposes three forms of market efficiency. Firstly, we have the weak form efficiency, which states that past prices and volume data are already reflected in the stock price. Therefore, technical analysts who use this data to outperform the market will be unsuccessful. Semi-strong form of the EMH states that fundamental and macroeconomic data is already reflected in the stock price. Therefore, using fundamental techniques is bound to be ineffective. And the strong form states that the use of inside information, or as coined by Farmer, monopolistic access to any information that is relevant to price formation, is likely to be is not useful to outperform the market, as all that information is already reflected in the stock price. So, in other words, the EMH states that active market analysis is a wasted effort, and that investors should select a passive buy and hold strategy. Now, according to the modern portfolio theory, in an efficient market, the market capitalization weighted portfolio is most mean variance efficient. So let's just first look at what market capitalization weighting is. It is a widely used metric in the investment industry. It's simply your shares outstanding times the price per share. And examples of well-known indices which use market cap weighting include the S&P 500, Russell 1000, the Wilshire 5000, as well as South Africa's JSE All-Share Index. Advantages of using the market cap weighted index is that it automatically rebalances and provides a passive and diversified strategy, and it is low cost, as you don't have to incur turnover and portfolio reconstitution costs. Now, the drawback of cap weighting is that it is highly price sensitive. Now, in efficient markets, we told that prices fully and fairly reflect all available information, and prices reflect the intrinsic value of a stock. However, in real-world markets, prices tend to overshoot their fair values due to, for instance, anomalies such as overreaction suggested by DeBont and Taylor and the subsequent reversals, as well as momentum, which was proposed by Jagadish and Titman in 1993, which we'll discuss later on when we look at technical analysis. Behavioral biases and irrationality of investors also leads prices to stray from their intrinsic values, and this culminates into temporal shocks, or what Siegel referred to as noise within the market. As a result of noise within this market, investors tend to overweight overvalued stocks and underweight undervalued stocks, which results in underperformance of cap-weighted indices, or what is referred to as the cap drag. Henceforth, we would like to use alternatives to market cap weighting in order to see whether we can achieve more mean variance efficient portfolios. Now, the first alternative asset allocation strategy we look at is fundamental indexation. Now, looking at this room here, we've got 5 individuals who are, well, I can say that fundamental indexation is their forte. So if I say something wrong, please do correct me here. So fundamental indexation uses the fundamental metrics of a firm in order to determine the weightings assigned to each stock or security. The advantage over market cap weighting is that it is a price insensitive method of weighting, and as suggested by prior literature, it provides higher risk-adjusted returns than cap-weighted indices, which also translates into more mean variance efficient portfolios. Some of the evidence on fundamental indexes, well, the proponent was initially Arnott Suen Moore 2005 in the US market on the S&P 500. Estrada and Suen Campolo show evidence of higher mean variance efficiency of fundamentally weighted indices in global markets. Ferreira and Krieger in the South African market, as well as Shea, Hodnett and Van Rensburg in global equity markets by adopting the Dow Jones Sector Titans Composite Index. Another alternative to cap weighting is your equal weighted indices. Now, equal weighting assigns equal weights, as the name suggests, to all securities. It is also coined as a price insensitive strategy, as pricing errors are expected to be random because you assign equal weightings to all the stocks. Evidence has been found in has been suggested by Arnott, Klasnick, Mochtada and Skoll 2010 in developed markets, as well as Charles, Su, Kalesnik and Little in US and global markets. One of the biggest criticisms of equal weighting has been the lack of liquidity and capacity of small stocks. Because you assign equal weightings to all the stocks, a large firm is assigned the same weighting as a small firm. However, that small firm may not have the required liquidity. And thirdly, we have optimization techniques. Now, optimization-based asset allocation involves identifying the optimal weights that will maximize a particular objective, such as a Sharpe ratio. The two distinct types of optimization techniques are your static and your dynamic models. And a static model identifies the weights at the beginning of the period and holds those weights constant throughout the evaluation period, whereas a dynamic model uses rolling time series analysis in order to identify the optimal weights that can be identified and applied in the next period. Now let's just look at two studies here. We've got Amenk, Goltz, and Martellini and Redkowski 2010. These are individuals who are part of the EDHEC Risk Institute, and they conducted a study which uses optimized Sharpe ratio optimized rolling time series allocation. So they use a 2-year period in order to identify the optimal weights to allocate to each asset, and based on the weights over the past 2 years, the weights that maximize the Sharpe ratio, they apply those weights into the next period. And they find that the strategy provides higher, more mean variance efficient portfolios than the alternative cap weighted indices. And also, and based on the results, they coined the strategy the efficient indexing technique. In a subsequent study, Shea, Hodnett and Van Rensburg also test a dynamic weighted least squares technique, which is conditioned on maximizing the Sharpe ratio. Their strategy allocates, also adopting the Dow Jones Sector Titans Composite Index, which is used to develop value and momentum indices. They use this technique to identify the optimal weights over the past or rolling 36 months that can be applied in the next month. And their strategy shows that the results provide more mean variance portfolios than the cap-weighted MSCI benchmark.
Now, excuse me. Can I just interrupt? For the static method, what if you determine the weight at the beginning, and the next period it doesn't give you the Sharpe high Sharpe ratio? What do? Do you change it